In the previous video, we did learn about the IPO. If you haven't watched, the link is available in the description. Please watch. And if you have not subscribed to the channel yet, please do and click the bell icon to get the alert on the new videos. All right, in this video, we are going to learn about the stock market index. In NSE, more than 1,400 companies are listed. If I were to ask you how the stock market is moving today, how would you answer my question? It will be very difficult, isn't it? It's not possible for you to check every company and figure it out if they are going up or down for the day and then give a detailed answer, isn't it? So instead, you would just check a few important companies across the key industrial sectors. If a majority of these companies are moving up, you would say market is up. If the majority is down, you would say the market is down. And if there is a mixed trend, then you would say the market is sideways. So essentially, identify a few companies to represent the broader markets. Every time someone asks you to how the market is doing, you would just check the general trend of these selected stocks and then answer. These companies that you have identified collectively make up the stock market index. So there are two main markets in India, the BSE Sensex representing the Bombay Stock Exchange and Nifty representing the National Stock Exchange. What do we understand from this index, which is very important for us to have some basic knowledge about it. One is information. The index reflects the general market trend for a period of time. It can be for the day or for the week or for the month or over a long-term period. On 23rd July 2021, at 9:20, the index value was 15,871.65. At 9:40, it was 15,778.50. So the earlier thing, we understand that the market is bull, meaning when the market is opened at the time of 9:20, it was bull, and later it was a bear, right? So the investors use such information to enter or exit their trade. Number two, benchmarking. For all the trading or investing activity that one does, yardstick to measure a performance is required, isn't it? So assume over the last 1 year you have invested 1 lakh, right? And that is generated about 20,000. So that makes the total corpus as 1,20,000. So how do you think you have performed? Well, that's the 20% return, right? That looks very great. However, when the pandemic started, the market crashed from 12K to 8K and it zoomed to 16K, almost 100%, right? So does that mean you are underperformed the market? The fact is, yes. So the whole objective of the investor would be always you overperform the market. That's when you see the return of investment more, right? So that is second. And the third one is trading. Trading on the index is probably one of the most popular uses of the index. Majority of the traders in the market trade on the index. They take a broader call on the economy or a general state of affairs and translate that into trade. Example, impact of the news, when RBI comes up with the policy changes, tax regulations, oil price change, war, and etc. So all these, big news is totally driving the market up and down. The next one is about portfolio hedging. Investors usually build a portfolio of securities. A typical portfolio, may contain about 10 to 12 stocks, which they would have bought from a long-term perspective, right? While the stocks are held for a long-term perspective, they could foresee a prolonged adverse movement in the market, potentially eroding the capital in the portfolio. In such a situation, investors can use the index to hedge the portfolio. So we will explore that in detail in the upcoming, episodes, right? So let's try to, understand the construction of the index, right? It is very important to know how the index is constructed or calculated if you use the index as a decision maker and trade accordingly. As we discussed, the index is a composition of many stocks from different sectors that collectively represent the economy's state. To include a stock in the index, it should qualify certain criteria. So there are 4 different formulas to arrive at. So one is market capitalization, that is the shares outstanding into the current market price. And two, multiplying the market capital with the IWF. So that is the shares available for the public trading, free flow map, maybe, using the market capital, whatever we have, multiply with that IWF, you would get that. And free flow market cap multiplied by the weightage assigned to the individual stock into IWF, meaning multiply with the weightage. And the next one is divide the market capital with the base value of the market, which is the current market value, divided by the base market capital into 1,000, right? So these, different calculations brings you the weightage for each and every stock. So in the NSE, we pick the first 50 weightage that is given by, and that's how we are, framing the index, right? So let's try to understand the common, jargons frequently used in the market. So it can be used for a script, or it can be used for an index. It can be used for futures and options, everywhere, right? So bull market, bullish. Generally, that is without considering any of the factor. Okay, let's assume the very general thing here. If the index or the stock is trading above the previous day closing, it is considered as bullish. Bear market, bearish. It's totally opposite to the bull market. So if the index or stock trading below the previous day closing, then it is bearish. Trend. The term trend usually refers to a general market condition or a market direction and its associated strength. For example, if the market is declining fast, the trend is said to be bearish, right? If the market is trending flat with no movement, then the trend is to be sideways. And the next one is 52-week high or low. Generally, 52-week is 1 year, right? So it means that last 1 year, the market or the stock can trade with any direction, any movement it could have been given. So where the lowest point in the last 52 weeks is called as the 52-week low, and the same period, wherever the price, hit the highest one, that is called as 52-week high. An all-time high and all-time low. So this is very similar to the 52-week high and low, with only the difference being all-time high is the highest, price of the stock, traded since it came to the public. And similarly, all-time low is the lowest price since it came to the public. Okay. The next one is upper circuit and lower circuit. The exchange sets up a price band at which the stock can be traded in the market on a given trading day. The highest price the stock can reach on the day is the upper circuit, and totally the opposite for the lowest price the stock can trade, right? So the limit for the, the circuits can be set up with, 2%, 5%, 10%, 20%. It's totally based on the exchanges, selection criteria. Let's not go into deep, it's not required at this moment. And the next one is about long position. So long position are, going long is simply a reference to the direction of your trade. It means you bought the index or a stock considering that this will go high in future. Short position. Going short or simply shorting is a term used to describe a transaction carried out in a particular order. This is a slightly tricky concept because the exchange allows you to short the position without even holding it, but you should cover on the same day. However, on the futures and options, this is totally a different way to handle it. We'll discuss that in detail when we are covering about the futures and options. Next one is square off. Square off is a term used to indicate that you intend to close an existing position. If you're long on a stock, squaring off the position means you're simply selling that off. So when you're selling the stock to close an existing position, then you're not shorting the stock at all. Okay. Intraday position. So this is a trading position you initiate with an expectation to square off the position within the same day. So it doesn't matter you buy or sell or buy later. So it's supposed to be happening on the same day. OHLC. OHLC stands for open, high, low, and close. So we will discuss in detail when we are studying about the technical analysis. So this OHLC is talking about on that particular day, what is the, a stock or an index, where it opened, where it went high, where it went low, and what is the current closing price which is trading right now. The next one is volume. It is a very important measurement to understand the interest of the buyers and sellers towards the stock. The more buy volume simply predicts the demand is increasing for the stock, assuming the volume is high on the buy side. Okay. The next one is stock or cash market. This is actually dealing the stock using the money directly on, trading on the equity segment. Next one is futures and options. So futures and options generally referred as to the equity derivative segment that would, trade with the leveraged products. Okay. So these are all very high level generic jargons that we use in a day to day, in the stock market. Right. So let's try to understand about a trading terminal. To execute the desire of buying shares must be done on the trading platform. I hope you remember our episode 2 where we discussed the market trading place, which is not a physical location but a digital platform. The stock brokers facilitate this for you to trade in many sectors like equity, derivatives, commodities, mutual funds, bonds, and currencies, and etc. For example, brokers Sharekhan provides Trade Tiger as a platform for you to deal this. Zerodha provides Kite, and there are so many brokers and providing the platforms with the different ways and different structures and different styles. But obviously, everyone's ultimate objective is to buy and sell and earn money. All right, so this is about the trading terminal. So whenever you are getting into the price option and buying or selling the shares, at the end of the day, you have to get into the settlement, right? So that is a clearing and settlement process, again handled by the brokers. So settlement usually happens, day plus 2. It means that, if you buy a share on Monday, at the end of the day, your broker will, deduct all the share purchase values, the brokerage commissions, the security transaction charges, and GST, SEBI charges, and, any more charges, that might come, in future. So, he does all these, calculations, and whatever the cash which you have kept in the broker's account, that will be, deducted. And day one, if you wish to sell the stock, you can do that. This is called actually, buy TST or ATST. Buy TST is buy today and sell tomorrow. ATST is acquire today and sell tomorrow. Both are same. So it means on day one, the stock is still not credited into your demat account. And this is still in the process of clearing. And it doesn't mean that, it has to really wait for that to come into your demat, and it can be sold at any time. And day 2, by end of the day, you should see the shares credited to your demat account. So this is a basic thing about the clearing and settlement. And the next thing is that the key events of the company. So as you know, the particular company's price, goes up and down, depends upon so many factors. But the things which I'm going to tell you right now are the primary things that any news when the company is coming out to the public and announcing that will impact very high on the trading, right? So one is dividends and bonus issues, stock split, rights issues, buyback of shares. So these are all the things, which impact more on the general day-to-day trading of the company, right? With this, we are closing the series of basics of the stock market, and we will be starting a new series for technical analysis. If you have not subscribed to the channel yet, please do and stay tuned. Thank you. Bye-bye.